Good afternoon, everyone. Welcome to our CreditSights Asia Credit Wrap, the November version. We're together with our analyst. We will be sharing the interesting trends we are seeing this month and the areas you will be interested. So together with me, our usual guest, we have Lars, we have Pius, we have Zerlina, and we have Karen. So today, allow me to start from Zerlina. And this is the time of the year we have fully launched all our 2026 Outlook, as well as our sector snapshot across the globe. Versus the first preliminary version in October, what do you see? There is major change. Any other top-down views?
So overall, there are no major changes across all the global fixed income analysts. I guess for the US, the government had been shut down for a while, so there was very limited data. But overall, the direction of travel has been largely in line with our expectations. So again, for the US outlook, in terms of our Fed view, we are looking for a 25 basis point cut in December and another 75 basis point cut throughout 2026. We are still quite bullish on US duration. We're looking at US 10-year yields going down to 3.5%. For US IG credits, we are targeting the spread to widen to 120 basis points, and that also means an excess return loss of about 140 basis points. So we maintain our underweight allocation to US IG for excess return investors. But for total return investors, we are quite positive. We're looking at a total return of about 7.3% for US IG, and we have an overweight positioning for total return investors. For US high yield, we expect spread to go much wider because of gradually deteriorating credit fundamentals, the corporate balance sheet releveraging activity, as well as a further tapering of technical tailwind. But we still prefer US high yield over US BSL. Now moving on to Asia credit market, this year has been great for Asia credit investors in terms of total and access return. Asia credits outperformed the US and Euro peers. I think a lot of the supporting factors are likely going to persist this year. That includes the technicals. This year, we're still looking at an active net supply, slightly narrower than last year, but still remain active. We think the macro credit and funding conditions are going to be still supportive, but we are still looking at Asia IG spread to widen to 100 basis points because of lower US Treasury yields. So we have an underweight also for excess return mandates, but for total return, we're also overweight Asia IG. Now, in terms of a strategy, we prefer duration over credit risk. For duration plays, we like the intermediate and long end of US Treasury. For Asia credit, we like to add duration for 7-year and plus in the high quality IG space for total return mandate. But for excess return mandates, we would caution on duration because of the potential large negative excess return when the spread widen at the long end, and we still see better value at the front end for excess return mandate. Now, in terms of credit risk, we still would like to position both in high quality credits as well as selective IG beta and high yield names. So we think next year is quite a lot about credit selection, and we still think there are some upside in the credits with improving stories as well as special situation. But in terms of beta, this will be a limited opportunity. We think it's better to focus on carry and roll down instead of spread compression. At the same time, we also published our 11 Asia sector snapshot. The changes are mainly we downgraded Asia IG financials from outperform to market perform, and we also downgraded, from market perform to underperform, and we also downgraded Asia IG auto from outperform to market perform umbrella. That's mainly based on valuation. We still maintain an outperform on Asia IG banks, utility, and leisure. The first two is mainly for defensive positioning, and leisure is the sector we see there are some the beta opportunities or spread compression opportunities. Rest of the sector underperform is still Asia IG basics because we see quite elevated headwinds towards this sector.
I think Zerlina for a very comprehensive wrap of the market. And when it comes to the Asia, we would like to start with Pius for the sector outlook.
Thanks, Fala. Yeah, so I'll provide a quick sector outlook on the AG on Asia IG real estate first. Overall, we are market perform recommendation over this sector because we see that there's limited potential for further spread tightening. And in terms of specific credit recommendations, we have picks on WARF, on the Sun Hung Kai. We have also potentially, if you are adventurous enough, you can start looking at Greentown, because we see that the Vanke default risk resurfacing may cause a pressure to the property sector, bonds in general, and that may cause buying opportunities on Greentown. And as to the themes that we want to mention for the IG real estate sector in general is that, firstly, on the Hong Kong side, we see that the office supply is still going to be pressuring the sector's rental and occupancy rate. On the retail side, we see that there's some green shoots in terms of the higher year-on-year growth in the retail sales in the past few months in Hong Kong. And on the residential side in Hong Kong, which is a subsector that we are most positive about, we see that the continued talent inflow into Hong Kong will further support the rental level, which has actually reached all-time high, and will also support the housing the price in the next year as well. Moving on to the mainland China side, we are a bit cautious on the home prices in China because of the high inventory level, underwhelming policy stimulus so far, and also what's happening with the Vanke. It seems that, as mentioned just now, its default risk has been resurfacing. And I also want to highlight our outlook for the Asia retail, tech, and the media sector. So overall, we are market perform on this sector, again on valuation as well. And specifically on the credit recommendations, we like Baba, Tencent, and LGES, LG Energy Solution. And we have pants on a few names, mainly because of valuation, and some of them because of the credit outlook. That's a JD, Meituan, Baidu, Xiaomi, and the TSMC. As to the themes that we are seeing in this few sectors, there are quite a lot, but we just want to highlight a few. First, it's around quick commerce expansion. So the spending in the quick commerce in China across these few names of Baba, Meituan, and the JD, they are going to create some revenue upside, but then it's going to be hurting bottom line across all these players. And it's also going to, from a longer term perspective, it's also going to be causing some structural shift in the market to the detriment of the Meituan more so than the others. And then secondly, it's on the national subsidies, national consumption subsidies. We see that the national consumption subsidies in China has been scaling down in this year, especially towards the second half of this year versus last year. So we see that there's going to be the weakening of the growth in the home appliance segment, and also on the electronics segment in general as well, which is hurting e-commerce players like Baba and JD. And the third, it's about AI. So AI is going to be directly benefiting a few players under our coverage, and it's also going to be integrated into the business model of the many players in the tech space as well. And specifically, AI obviously is going to be benefiting semi supply chain. So that's our SK Hynix and TSMC. And the AI as a part of AI cloud is also part of the core growth drivers for Baba as well. And we also see that AI, the power tools, advertising tools will be helping with improving the targeting in the online advertising for advertising players here. That's Tencent, Alibaba, and Weibo. And lastly, on my end, I will also highlight our outlooks, our sector outlooks on the Asia IG leisure segment. That's on the gaming segment. As mentioned by Zerlina just now, that's one of the few sectors that we still have an overall outperform recommendation on. And maybe it's because of a constructive outlook and also because of valuation pickup, 50 basis points pickup over the index. But here we just have two names. One is Sense, which we have market perform recommendation on, and then the other one is Genting, which we have outperform recommendation on. As to the themes, we'll be watching out for our visitations will still be resilient in these gaming locations because of support for tourism in the form of mega events, in the form of eased visa requirements. But then we will be cautious actually about Macau gaming's outlook in the medium term because we are still concerned about the consumer sentiments as a result of this still very weak macro outlook in China. And also it looks like the equity market is losing steam, so which is going to be causing some negative wealth effect.
Thanks, Pius, for the detailed run through. So let's come to Lux for Southeast Asia.
Yeah, sure. So continuing on from where Pius left off on the leisure front, the Genting is a name for where we like the Genting Malaysia Soul bond. That is on the back of the transfer of risk that we see for any further capex investment from Genting Malaysia to its ultimate parent Genting Berhad. We also think that some of the capex outlay for the new New York casino that we expect and the general market expects that Genting will win one of the licenses will mean that there will be a little bit more burden that will be taken on by the ultimate parent. For Genting Malaysia, the spreads really blew out after that takeover announcement by Genting Berhad. And at these levels, we think that there is room for some tightening. For the other sector outlooks under us, where we have a fair number of issuers, one of that is the oil and gas sector. For that, in terms of outlook, the main risk that we see for 2026 is the crude oil prices. So even our sister company, our sector our analyst forecast that the crude prices could be lower on a year-on-year basis. They could be somewhere in the $55 to $60 per barrel. So inevitably, the upstream companies their profits and revenues will be impaired. On the other hand, the downstream companies where we have still a fair number of issuers, they will benefit from lower feedstock cost. The other is the general, the supply concerns from OPEC plus consortium, the geopolitical concerns that could come up in the Middle East that could curtail or increase the supply. These pose, various demand supply risk for oil prices. Other than that, capex and high dividend payouts is one of the key themes that we will be watching out for as they are looking to invest a lot into the green transition. The next sector, just keeping to the very broad themes rather than going into companies, is that in the utility sector, we think that it's going to have fairly stable, steady growth. We are not overly worried about any specific kind of issuers there. Here again, the green capex will entail large investments for many of these issuers in the next few years, not just 2026. But overall, we think that the government support for many of these state-owned utilities will still be available, will still be present, and that in some ways, there could be higher dividends that we could expect, maybe for some of the Indonesian SOEs, given the Danantara that is coming into the picture. But generally, we are not way worried, or we are quite comfortable with many of their credit profiles. Very lastly and briefly, the food sector that is involving Indo-food, etc., is still expected to do fairly stable and benefit from the Indonesian government's free lunch program. I'll pause here.
Okay, thanks, Lars. Next, let's turn to Karen on the financial sectors.
Yes, I will talk about the outlook for bank and financial services. So as Zerlina mentioned, we have an outperform recommendation on the banking sector, and that is mainly because, firstly, the bank sector currently trades 10 basis points wider than the IG index on OAS basis, but historically it has been tighter. And secondly, the sector is viewed as a defensive sector to us, which is preferred in 2026. And lastly, we see the overall fundamental of the Asia IG banks as comfortable. So the net interest margins will continue to head lower, but to a less extent than this year. Loan growth will remain soft, but will remain at similar levels as this year. Now, interest income has been particularly strong this year, but whether this trend can last into next year will be contingent on the capital market conditions. Asset quality will remain stable and comfortable, and credit costs should be flat or lower as trade uncertainties are decreasing, and many banks have set aside substantial preemptive provisions this year, particularly for South Korean banks and Singapore banks. And lastly, the capital and liquidity metrics have and will continue to remain comfortable. So for this sector, we have an outperform recommendation. But on the other hand, we are downgrading the recommendation on financial services from market perform to underperform. And this is due to several reasons. The first is that this sector, the spread premium it has over the IG index has remained near historical lows. And secondly, the positive catalysts that are mainly from the Chinese AMCs and Korean securities house have largely played out this year and will unlikely be seen again next year. And certainly, so far this year, the sector's performance has been largely supported by a risk-on sentiment, and we don't think this will sustain into 2026. So overall, we think the sector's performance, we have an underperform recommendation. That's it.
Thank you, Karen. As this year is coming to the end, we still have analysts working very hard on the new initiations. There are a couple of interesting names which has been asked by the market and clients, and we will start with Pius for Fosun.
Thanks, Flora. Yeah, so we just came out with a big piece this morning, Fosun initiation. So we initiate on Fosun with a outperform recommendation. So Fosun, it's a low double B credit with 6 bonds outstanding, 4 dollar bonds and 2 euro bonds. We like it because we think that its core investment subsidiaries are going to be offering a stabilizing fundamental performance, and also that it's going to continue to delever via disposal of its non-core assets in the medium term. From relative value perspective, we compare the bond with China BB rated corporates, and also with more broadly Asian high yield investment holding companies such as Rakuten and the SoftBank. And we see that it offers the value against discounts. And we see that there's a potential for the 30 basis points spread tightening. Yeah, so just a quick introduction to the Fosun. So Fosun is a Hong Kong listed investment holding company with a 40 billion Hong Kong dollar market capitalization. It operates across 4 segments, primarily through portfolio companies. And the 4 segments are health, so that's pharmaceutical, happiness, that's jewelry retail and resort, wealth, that's insurance and asset management, and intelligence manufacturing, which is basically upstream mining and oil and gas. So you can see that it covers a broader range of vastly different sectors. So to put it simply, you can think about Fosun as an investment holding company sitting at the holdco level and makes a strategic decision in terms of financing, acquisition, and disposal over its portfolio assets. I want to spend 1 minute to highlight how we are differentiated in our research versus our peers. I think firstly, it's there are very few initiation level coverage on Fosun in the market, simply because it's very complex. And secondly, it's that even for some of the very few initiation coverage on this name, so no one has really gone into detail into looking at the key assets individually and to form a view as to their credit, as to more importantly, their equity story. So we see that we are differentiating here. And in terms of audience, we think that it's really a broad range of audience. So for Chinese investors, they might have invested in the name, but they probably don't know the name well enough. So it's a good opportunity for them to ramp up their understanding of the credit. So when this opportunity comes, then they can probably size it up as needed. And for European investors, they have seen the name around as per our understanding, but then they haven't been investing in this name in a big way. The reason that why this name appears on their list is because it's one of the rare private sector Chinese corporates that have Euro bonds outstanding. So we think that they are potential audience as well. So we did many analysis in this piece, but I just want to highlight a few key analysis why we are doing this and the key takeaway here. So as mentioned just now, on a broad level, we look at Fosun as an investment holding company, and the key analysis actually revolve around the concept of a loan to value LTV, and that means we look at so on the holdco level, it raises debt and equity capital, and invest this capital into equity of its portfolio assets. So we need to form a view as to how well its assets can cover its debt, because we are debt investors, basically. So the loan meaning the debt, and then the value meaning the equity value of the assets. And when we are analyzing the concept of LTV, we ask ourselves 3 questions. One is where the LTV is. Secondly is where the V is going. Is it going up? Is it going down? And then thirdly is if the L, the loan or the debt, is sustainable. So these are 3 questions. We answer them one by one. So firstly, on the LTV ratio, it's 40%, which is comfortably low. Its assets are well diversified. It doesn't have an asset that's larger than 15% of its portfolio value. And it generates around 50% revenue from China and overseas, so which means that it's well diversified. And 43% of its portfolio value are in the listed assets, which means that their valuation is transparent. And on the second question as to the where the V is going. So as mentioned earlier as well, we evaluated 7 key assets across 7 vastly different industries, which together represents 60% of the portfolio value. And we get comfortable about the profile of these companies in terms of their credit profile, in terms of the equity profile, and in terms of their market positions as well. And as to the third question, it's if we are comfortable with its L, whether the L is sustainable. So we look at the capital structure, the liquidity on the holdco level, and we get comfortable there as well. Its net debt was down 20% in the last 2 to 3 years because of massive asset disposal. Its liquidity was sufficient. We estimated that it's on a forward-looking basis, its recurring cash inflow, meaning that the dividend income from its investments can sufficiently cover the recurring cash outflow, which is its interest expense on the holdco level as well. So overall, it's a big piece. So I would encourage clients to take a look at that and then come back to us with questions. Thanks.
Yeah, thanks, Pius, and we really were looking forward to this piece. Just also to highlight that we put a lot of efforts on all those. If you have any feedback, it's a good piece, or if you have any feedback in the comments, please let us know. Then let's turn to Lux. You have also interesting names, and Karen. You have interesting names.
Yes, from our Southeast Asian Bank, the Southeast financial team. So they initiated coverage on Piromo Finance, which is Indian retail-focused NBFI. And it is one of our initiations this year for these Indian names. So Piromo is started its early years with a focus on wholesale real estate financing, which is largely KCIE lending. But this, however, led to some problem during the multiple year of down cycle in India's real estate market, and it left the company with a legacy portfolio of bad loans. So in 2020, Piromo undertook a strategic overhaul and tried to shift its focus to retail lending. And currently, retail lending accounts for over 80% of the company's total portfolio, which is a good diversification effort. Piromo is improving story, so its profitability is improving and its asset quality has remained stable since its overhaul. But we also noticed some key risks, which is mainly from its new retail book, which is somehow unseasoned and untested by an adverse economic cycle. Additionally, the management seems to have an appetite to grow its riskier unsecured book. So these are the two main credit risks in our view. But we compare it to other NBFI peers, and we see upside potential of 25 to 30 basis points. So that is why we have an outperform recommendation on this name.
Thank you very much. So now let's turn into the earnings report. Then which we can start from the China Tech and the Korea corporates.
Sure, thanks, Flora. Yeah, so I won't go through all the other names because there are just too many. So I will just highlight a few key ones that are interesting. They're more topical than the others, and that we have either outperform or underperform recommendation. Yeah. So first one, it's on Tencent. So Tencent, we still maintain our outperform recommendation after its very good third quarter results. Valuation is still quite attractive. We particularly like its 41s versus its comps. In terms of its performance, its operating performance, third quarter revenue was up 15%. So that's an acceleration from prior quarter, and so EBITDA margin expanded further by 3 percentage points to 45%. The key drivers here are really multiple across all fronts. It's seeing accelerating growth in its international game segment and its online advertising segment. In terms of margin, it benefits from a better product and segment mix as well, and also it's benefiting from a cloud cost saving as well. So going forward, we think that it might achieve a net cash status by the end of 2026. So moving on to Alibaba. We still keep our outperform recommendation after its weak but expectedly weak result in the Q3. It's still offering 10 to 30 basis points spread to pick up over its comps. So although it's Q3 performance, although it's Q2 physical quarter performance is weak, but then we expect that it's going to be stabilizing in the next 6 months because of the reasons that we'll mention later. So in terms of its Q3 performance, its revenue was up 5%, which is ahead of expectation. But its EBITDA was down massively, was down 13 percentage points to 7%. And as to its drivers, its revenue grew because of its accelerating growth in its cloud intelligence segment, and also very rapid expansion in the quick commerce segment. However, this comes with an expense. It spent massively, it spent a lot of money on promotional spending to expand its quick commerce segment. So that's why its EBITDA was down so much. And that's why its credit metrics got weaker as well. But we are not so negative in the next 6 months. So we see that it's going to be having a stabilizing 6 months ahead. And it's because its cloud segment is going to continue to grow, to contribute to the top line and to bottom line. And on the quick commerce segment, as guided by the management, it's a December quarter. Unit loss on a per order basis is gonna half. It's gonna be half as much as the September quarter, which means that the cost will be a narrowing. Moving on to JD. So JD, we still have our underperform recommendation on JD, mainly because its valuation. Fundamental-wise, its operating metrics and credit metrics were bad for the same reason as Baba, because it also spent a lot of money on food delivery, on expansion of food delivery business as well. Moving on to Xiaomi. Yeah, so Xiaomi, we still keep our underperform recommendation mainly on valuation. It's a BBB flat credit, but then trading at as tight as the low 8 level, which we think it's a little bit excessive. And we think that the potential positive rating actions from the Fitch and S&P have already been priced in. But for its Q3 performance, it's pretty good, especially supported by the EV segment. It's an EV ASP and a shipment, both did very well and actually exceeded expectation. And also its unit economics of the EV segment also improved a lot as well. And it just achieved operating profitability on the operating income level for the first time for its EV segment. Going forward, though, we are a bit cautious in terms of not that it's going to be you are going to be seeing declining in sales or declining in EBITDA margin, but it's more about not matching the market expectation. So we see risk in its EBITDA margin, whereby it's there's going to be pressure on there's going to be pressure on the smartphone segment and on the IoT segment because of a higher memory chip cost. And for its EV, the segment, management guided that it's likely seeing some pressure on ASP and on gross profit margin because it's going to be lowering the prices in response to the expiry of purchase tax benefits starting next year. Quickly moving to LG Energy Solutions, the Korean battery maker. So we still keep our outperform recommendation on LGES, maybe again on valuation, and also its third quarter performance is it's better than expected. Its valuation is still there's still some juice in its valuation. It's offering 20 basis point spread versus its comps. We expected that Moody's was going to downgrade the company to BBB stable, and it did happen. But then the spread didn't move at all per our expectation, which was encouraging. As to its performance, its revenue was down about 17% year over year in Q3. But EBITDA margin actually surprised to the upside. EBITDA margin was up 8 percentage points to 27%. And as to the drivers, its revenue was down because of lower battery demand from the U.S. because of the expiry of IRA consumption subsidies that happened in September. But its EBITDA margin was better than expected because of better plant utilization and a better cost control, which benefits unit economics. Going forward for LGES, we have a few positive developments to watch out for. One is its growth in energy storage system in the U.S. because of grid stability demands. And secondly, there's a potential for EV battery to pick up to its European OEM partners because they will be launching some new models. Yep, that's it for me. Thanks.
Okay. For the earnings, how about Lars? Anything to add?
Yeah. Thanks, Flora. I'll keep it fairly brief and then give a wrap of how the overall India, Indonesia, Thailand, Middle East earnings were. So broadly, fundamentally, really very sound, very robust earnings. All their revenues, EBITDA grew at a very remarkable pace, and there was deleveraging to boot. So because of the growth in EBITDA, all of them did see across the board, did see the leverage come down. So we are quite comforted by the improvement in metrics, and that kind of resonates with what we have been hearing from the street, from both of our strategists, Zerlina's also, that the fundamentals of many of these companies are still very, very robust. So this questions has come up when people question as to why the spreads are so tight, right? So in terms of the overall earnings, if you look at the Thai PTTGC, Thai Oil, there was improvement in their credit metrics. Biocon Biologics saw material deleveraging, which was in line with our projections. And even for that matter, many of the renewable companies like Greenco Renew also saw, despite their very high capex, they were able to generate fairly good growth in their EBITDA. In terms of revenue, it came on the back of higher solar cell module manufacturing. For Vedanta, it was a high metal prices, and there was resilience in their earnings in terms of their overall production numbers. For the Middle Eastern, Aramco, even though the oil prices were lower and given it is predominantly an upstream company, it was still able to eke out a solid, decent growth in its earnings, which reversed some of the weakness in the prior year quarters. For the other Indian companies, it is this pretty much same story, a very solid growth, and we could see material improvement in credit metrics. Quickly, I would like to point out the only kind of aberration or an exception was Indica Energy. That produced much weaker year-on-year earnings on an EBITDA revenue basis, and that came on the back of weaker coal prices. And this did not come as a surprise to us because we have had a very negative outlook. One, because of the coal price outlook, and secondly, because it has a lot of capex, including the material gold mine in Avakmas, where we expect there could be both delays and even higher capex, which has already been kind of announced by the company. So we maintain an underperform recommendation on Indica for that reason, and that's the kind of where we have seen how the earnings have panned out.
Thanks. Just turn to Karen on the financial side.
Yes, this month the financials team, we reviewed results from a lot of countries, but in the interest of time, I will just briefly summarize our takeaways from Japanese mega banks results. So in short, net profits broadly increased year-on-year in the first half of 2025 for Japanese mega banks, and all three mega banks, they increased their full year outlook for 2025. And we observe some common themes from their results. First is that domestic retail and corporate segments performed well, and that was due to a higher rate environment, which we think will continue. The second is that their loan growth was near stagnant, and this includes their international dollar book. and the international margins were either flat or lower. And certainly, fee income growth has been good. And lastly, asset quality has been particularly good, with credit costs trending lower, much lower than the initial expectations. So overall, we have been and continue to be positive about Japanese mega banks' credit fundamental outlook. And the only area of caution is the potential higher credit costs or goodwill write-downs related to the investments made in Southeast Asian banks or NDFIs.
Thanks very much. In the interest of the time, we have one last item before our Q&A. That will be our 2026 outlook and the 2025 wrap. I mean, based on our earlier report that Asia, excluding Japan, new issue reached about 156 billion this year, which is slightly above the last year, but below our expectation. Zerlina, maybe I could turn to you on this 2025 wrap at the 2026 outlook.
Yeah, thanks, Flora. So as Flora mentioned, yes, this year the new issue from the IG space is slightly higher than last year, but still below our expectation. And on the high yield space, the momentum is slightly faster, but still overall the absolute size is very small compared to the heydays of before 2022. So I think a couple of reasons. The first one is because for IG issuers, they are more looking outside the hard currency space. So a lot of them are doing Asian local currency, Australian dollars, in dollar and CNH are becoming very popular. Some of the issuers are also looking at the euro space because of the absolute relative funding cost is lower there. This trend will likely continue into 2026. If we look at the composition of the new issue year to date, still IG is dominating, financials are dominating, but we do see some continued issuance coming from the non-rated space. One of them are Philippines corporates as well as Chinese LGIVs. One interesting thing to note is a lot of the issuers are now doing floating notes because of the expectation of base rates going lower. So in the past, floating rate note is about only 10 to less than 15%, but now this is about 20% of the total Asia IG issuance. Moving to next year, we do expect the gross issuance to be higher coming from Asia ex Japan because of the lower base rates will likely encourage issuers to tap. Some of the pockets of the markets, for instance, Chinese SOEs, we are seeing them coming back to the market, and Chinese tech, they will likely have continued funding need, especially for offshore money, as Pius mentioned. There's a lot of initiatives in the AI space and also overseas expansion. Usual issuers are the Korean corporates. We expect some new tickers coming to the market, as well as in the financial space, Singaporean, Philippines, and the banks will continue going. Financial services space will continue to be some of sub-debt issuance. Another thing to highlight is in the Japan dollar credit issuance, we think it will continue to be very strong next year. This year, dollar issuance from Japan already exceeded 100 billion US dollars. That's more than 25% year-on-year growth. Next year, because of the GDP rates are going higher and it has been very volatile, the curve is also steepening because of the fiscal concern and GDP supply concern. So I think next year there will continue to be the trend of the Japanese issuers into the offshore dollar bond market. And so this might have some crowd out effects for the Asia ex-Japan space. So technical tailwind will likely still be there because ex-Japan space, the net issuance will likely remain negative, but we will see continued fund reallocation to Japan, Australia, as well as Middle East, which like Lux is quickly ramping up the coverage in that space as well. So that's a big picture view.
Okay, thanks very much. I mean, although this year's new issue is a little bit flat, but while I was in Hong Kong and Taiwan last week, I saw a lot of investors participating into the new issues. Just to check if anyone has any other comments on that.
Yeah, this one we do see some names that sometimes that is returning now. At the BDO Unibank, the largest Philippine bank, it recently returned with a 5-year bond, but that is also to refinance its sole dollar bond that is to mature in January next year. And China Orange AMC, it has also returned recently, and compared to its peers in that its dollar supply has been much more limited, and its pricing was quite fair in our view. But in 2026, we still expect the overall supply from the financial sector to remain much limited and maybe a negative net supply, because for the Chinese financials, they either have the option to refinance onshore or refinancing floating notes or refinancing the dim sum bond market. And even for Korean financials, they have cheaper domestic choice, and the Korean won is depreciating. So it is also not we are not in addition to refinancing, we do not really see a increase in the net supply.
Thank you. Anyone else? Okay. I think this is all what we have today, and we do receive some questions. Let me, because of the time, let me start with the first one. It's from Grace Lim. This is probably for Lux. Between Indonesia and India sovereign credits, which are more resilient?
Sovereign credits. I presume the question pertains to the sovereign bonds of India and Indonesia. So responding to that, I would say that currently, in the current circumstance, India would be perceived as much more stable. This is because on a relative basis, Indonesia is seeing a lot of concerns surrounding the Danantara issue. The one, it also has a lot of macro concerns, with relation to Mr. Prabowo's very ambitious 8% economic growth target by in the next few years, which will inevitably entail higher debt incurrence, and therefore there is the risk that the fiscal deficit could widen. Secondly, there has been a lot of there has been in some quarters or some investor base concerns over policy uncertainties. So that is keeping some of the investors away from the Indonesian sovereign bonds. And thirdly, a noise around Danantara about being set up. And what it means, not just for sovereign, but also for going one layer down to many of these state-owned enterprises like Pertamina PLN, is also kind of making people a bit more jittery. So in terms of in the current circumstance, I would say that Indonesia sovereign bonds are definitely a bit more less stable rather than the Indonesian ones. The same could be said for the Indonesian state-owned enterprises too, because a lot of these concerns that we talk about for macro does get reflected even in the Indonesian state-owned enterprises dollar bonds, as that is a way for the investors to kind of express their view about the macro. When it comes to India, the reason also why we think it's more stable now is because India is seen as a country within the Asian and even broadly in the emerging market space, which is seeing very robust growth and is expected to see good growth even near future. It's secondly, the geopolitical environment is much more stable, more predictable, and also because we have seen that there is the general corporate credit quality is much better now. As we have just even discussed, the earnings have also been very robust, and that is expected to continue to remain so. And therefore, there is much more opportunities for them to kind of invest in India. And therefore, the macro story is generally better. And for the sovereign credits is likely to be more stable.
Thanks. So I think we are going to wrap up this today. And thanks everyone's time. And if and wish you a early happy holidays. And if you travel to anywhere cold, don't get cold. Thank you, everyone. Thank you. you.